Good afternoon, everyone. Thank you all for joining us here today. My name is Denis Rudenko, and I'm the head of sales here at Oz Capital. So our main topic of discussion today will be employer pension plans, what they are and why you should probably check on your pensions, especially at previous employers, and perhaps take control of them. And additionally, we'll also talk about Oz Capital and talk about why we do what we do, how we achieve our impressive results, and how you can benefit by working with us today. We'll also go through a little case study in there on a retirement case study investing with Oz Capital. The main reason that I decided to focus on this particular topic today is actually due to a new client that I onboarded a few months ago. Let's call this guy John. So John came to a similar webinar, like I said, a few months ago. And I guess what I had said or what we had presented had resonated with him. He ended up calling me that same afternoon, and we had a pretty lengthy chat going into more detail on Oz Capital, our investment fund, the Oz MIC. And when we started discussing retirement with John, who's, in his sort of early 40s, so still not really there yet, but certainly thinking about it, John suddenly remembered that he had a pension plan from a previous employer that he had worked at for many years, which had accumulated some cash, so that he hadn't looked at for a long time. Anyways, long story short, he had over $75,000 in a pension plan that was sitting there for about 7 years or so since he had left that employer, and big surprise, it wasn't really doing anything. It was not being managed or actively managed either by him or by an advisor. And pretty much mostly what it was doing is paying over 2% a year in fees to the pension plan administrator, while the actual investment principal stagnated due to poor investment returns and lack of active management. So that was pretty eye-opening for him. And that's essentially why we decided to talk about this important topic here today. Eventually, we transfer the funds over to OzMIC, and the investor now earns a very healthy return on his pension, and will continue to do that, for the next 15, 20 years until John needs his money. So if we can get even a few people like John to kind of set off a couple of alarm bells in their head and say, hey, you know what? I did have a pension, even if it's, 15, 20,000, whatever it is, you guys really should check on what's going on with that money and make sure that your fees aren't checking into or eating into your returns, and that that money's actually working for you and eventually growing into a nest egg for your retirement. So without further ado, let's get into what types of pension plans exist in Canada. So in order to understand this, essentially each type has unique features that impact how your retirement benefits will accumulate over your career. So first and foremost, we have the defined benefit plans, which promise essentially a specified payment in retirement, which is calculated based on factors like your salary, years of service, etc. The key advantage here is a predictability with this type of plan. So the risk is managed by the employer or by the pension fund company. So these types of plans aren't really applicable to what we're talking about here today, but I thought it important to highlight it. Next are defined contribution plans, and this is typically the more common ones that you see with private employers, where the contributions are made by both you and your employer. Oftentimes there's matching in certain programs depending on the employer, but the retirement benefits depend on the investment's performance. Okay, so that's the plan that we're talking about here. This plan shifts more responsibility to you as the employee or as the individual that's going to be managing those funds, and essentially giving you more control over your investment choices, but also bearing investment risk. And lastly, there's a type of hybrid plan which can combine elements of both of defined benefit and defined contribution plans. These kind of offer a middle ground, typically with a portion that is under your control and another portion that is sort of more locked in terms of the types of investments that you can have within there. If we can look over at the next slide, we'll see that one common challenge, I mean, what the issue is, that one common challenge, as I said, many face when changing jobs is leaving their pension plans behind. Typically, these are held with a pension fund company, some of the biggest ones out there, places like Manulife and Sun Life, or, there's a lot of different ones. Again, not calling out any particular companies, just kind of giving you some examples. Those are some of the bigger ones. These plans are often sort of out of sight and out of mind. But in some cases, the issue is that, as I said, like in John's case, they might be eroding your future financial security because, again, oftentimes some of these products might carry high fees and also additionally provide very rigid investment options, meaning there's only specific mutual funds or segregated funds or specific investment vehicles that you can invest in within that plan. So it's really crucial to recognize that these types of stuck, I want to call them, pension funds are not just dormant. They're often underperforming significantly compared to, actively managed funds, or even just, a market tracking fund, something that is, just indexing the market. Taking control of these funds is not just about managing your money better, but it's about securing, a more prosperous and flexible retirement. So if we keep going here, let's talk about how you do that. Well, typically these defined contribution plans are what's known as locked-in money. Essentially, it's a way for pension companies to protect yourself from yourself, if you will. So the first step is to identify any dormant pension funds you have with your previous employers. Understanding where your money is the first step to taking control of it. The next step is transferring these funds into a locked-in retirement account, or LIRA for short. What this allows you to do is to continue to benefit from the tax-deferred growth while taking charge of how your money is invested. So we go from a DCPP to a LIRA plan. And a LIRA is not really just a safe harbor for your pension. It's a launch pad, really, for potentially higher returns, which gives you the flexibility to tailor your investment strategy to your current future and your needs. Now we'll turn over to our case study. Again, I'll get into specifically what, how we manage the Oz Capital MIC and what we do, but let's look at the scenario first. We've kind of jigged it up a little bit this time around. So this is a slide that I absolutely love because it really shows, the difference between earning a decent return and earning an above average return. So I call this the passing on your legacy slide. Did you know that come year 70, you actually have to convert either your RRSP or your LIRA into a RIF or an LRIF, okay? And what those plans do, it's a government mandated plan that requires you to start drawing income from that LRIF plan at age 71, okay? These withdrawals are expressed typically by a percentage that increases every year. Again, different plans work differently, but here we're looking specifically at, a $200,000 kind of starting point, which is, arguably not that much within retirement. And what happens to that money if it is invested into OSMIC, which I'll talk about the return profiles and all that stuff a little bit later, and what happens when it's invested into the high interest savings account. Again, keeping in mind that every year you have to withdraw a certain amount as prescribed by the government. So you can see the orange line there is the investment within OSMIC. The blue line is the high interest savings account. So that investment, that $200,000 invested into OSMIC, even with the withdrawals that we're talking about the annual withdrawals, will continue to grow until the age of 85. So that's sort of the inflection point. So from 65 to 85 for 20 years, you're actually still growing your initial nest egg. At this point, your investment will have grown to over $342,000 by age 85, while at the same time you've withdrawn some funds. Again, by comparison, you can see the high interest savings account, which we assumed a 4% rate for the high interest savings account, because that doesn't actually exceed the withdrawal percentages. You're actually seeing that money start to diminish from year one. So by the age of 100, through OSMIC, you're left with over $100,000 still in terms of principal within your account. Whereas with the HISA plan, or the high interest savings account, you've got less than $20,000 left to pass on to your your estate, your kids, your grandkids, what have you. And if we can move on to the next slide here, this is what the withdrawal amounts look like for those RIF and LRIF plans that are mandated. So again, looking at that same value, that same graph, like these two graphs are related, right? So looking at that same value, you can actually see that these annual withdrawals within OSMIC, because the percentage is going up and the account value is going up, your annual withdrawals keep getting larger and larger and larger within the OSMIC portion of the portfolio, while with the HISA, they stay pretty much the same, and they do get a little bit larger, but that's simply just product of the fact that each year the percentage that you have to withdraw is a little bit bigger. So at its peak, from OSMIC, you're getting almost $50,000 a year in cash flow versus around just over $12,000 from the HISA. So pretty compelling stuff here. We can discuss this in more detail later. And so again, let's take it back a notch, and let's talk about Oz Capital MIC. So our approach and what we do. So in front of you, you see this is what drives our company. This is a little story that I can tell you here about unpredictability. One of my favorite stories to tell on this. So if anyone's joined us before, you might have heard this, but essentially a few weeks ago, I was up north at my farm, or I call it my farm. We don't really grow anything there, but it's just it's a cabin in the woods. And I was taking a shower by myself, two dogs with me there. All of a sudden, one of my dogs just starts going crazy, starts barking and freaking out. Keeps going. I get out of the shower. I look out front of my house, and what do I see? I see 10 cows on my front lawn. Now, I thought to myself, I don't really have any cows, so not sure what's going on there. Anyways, it turns out the cows had escaped an enclosure just from up the road. And, without further ado, a neighbor and I got them corralled back into their enclosure. And, I was ready for my work day after that little bump in the road. So the reason I'm telling you this story is because when you talk about unpredictability, there's different types of unpredictability. Unfortunately, that type of unpredictability we cannot help mitigate at Oz Capital. But predictability within your financial future and your retirement is something that we absolutely can and would like to help mitigate. So how do we do this? Well, we do this through the Mortgage Investment Corporation. Let's take a minute to understand what that is and why MICs, for short, have grown in popularity with both borrowers and investors in the recent years. So simply stated, a MIC is a pool of investors' money, which is invested in a portfolio of mortgages. Okay. I know that chart there is pretty confusing. I understand it, but most of you don't. And just at short glance, I wouldn't expect you to. But again, simply stated, it's a pool of investors' money. That money is then invested in a portfolio of mortgages. Okay. MICs can lend on a variety of different properties in Canada, and they offer the investors, or our investors, the opportunity for a diversified and asset-backed investment vehicle. The interest earned on that portfolio of mortgages then gets passed on to our investors in the form of monthly distributions. And although MICs have been around for a really long time, it's only recently that they've grown in popularity and use with both borrowers and investors. So what sets us apart? Here at Oz, we really like to start with the people. The people are the most important thing in our organization, whether they're our investors or they're our clients or they're our employees. So we really like to focus on the fact that we have three sets of eyes on every deal. And the reason we do that is because anybody can have a really bad day or, an off day and miss something. So to ensure that nothing slips through the cracks, we always have at least three sets of eyes on every single deal. Now, those three sets of eyes are our two co-founders, Zvika and Oleg, who were mortgage brokers for many, many years and understand and have seen everything out there, and our head of underwriting, who has ran a major underwriting department for one of the biggest lending companies in Canada. So to ensure that this happens, to ensure that nothing slips through the cracks, we ensure that all three of these people look at every single deal that we underwrite. We lend on liquid residential real estate. So this is pretty important. Everything out there is not liquid. And when I talk about liquid, what I mean is we lend on urban and suburban houses and homes or condos that look like other homes or condos on the street. Okay. I'm not talking about, sorry, the color of, the walls or the siding or whatever. I'm talking about homes that can be easily valued, making them, essentially very easy to liquidate should the need arise. We also only lend in the province of Ontario, Ontario being the most lender-friendly province in Canada. Ontario, you can trigger the power of sale process just 15 days after non-payment. Now, obviously, in practice, this isn't something that we do unless we have to, right? We try to work with our borrowers and make sure that they get back on track to make those payments and achieve their financial goals. But if things don't go according to plan, we have the power of sale process to fall back on. I'll run through this quickly. We're short-term in nature. This means that we can pivot very quickly with market conditions, with changes in those conditions. We can tweak and fine-tune our lending criteria. And it's important for us to make sure that we have a clear and achievable exit strategy for every one of our borrowers, whether that means selling the property or improving their credit score to refinance with a more traditional lender. So, and the last thing really, and probably one of the most important things, is that every single dollar within the portfolio is secured through real estate. And I would argue some of the best real estate in the world here in Ontario. I'm partial. So hopefully now you have a much better understanding of what a MIC is and how we run the Oz MIC specifically. And here are the results. We've got steady, reliable income month after month and year after year. This is what we mean when we talk about being able to sleep at night. The chart you see here shows Oz MIC, versus two benchmarks that we use here. The first one being a basket of North American stocks, and the second one being a basket of Canadian bonds. So the iShares universe of bonds, Canadian bonds, and the S&P TSX composite. So bringing this back a little bit, I would much rather have that money growing, bringing it back to, to John, our guy from before. He would much rather have his money sort of growing in a nice smooth line with Oz rather than going up and down like this in some of these other products. So lastly, let's shift gears and focus on, you, the investor. So we've talked a little bit about pension plans, the types of pension plans out there, and what you can do to potentially seize those funds. Now, again, we would like for you to just be aware and to check on those things. We certainly are happy to help you invest with us and to invest a portion of those funds with us. And the way that we do that is in the following 3 steps. So we have an initial consultation. So I would have that initial consultation with you, just like John called me on the phone, and we had a 30-minute chat or so and uncovered these hidden or these forgotten pension funds. So this is free of charge, and I'm happy to have a chat with anybody that calls us. If we decide to move forward and that that you're wanting to bring some money into Oz Capital MIC, we will complete a know your client assessment, and I'll help. I'll conduct the interview and I'll fill in all the forms. I'll guide you every step of the way. Okay. Lastly, we submit everything, and you can invest into Oz Capital MIC and benefit from our steady and reliable income for years. So again, just to kind of sum everything up, everything we do is focused on people. We focus on you. We treat our clients as the most important part of our business, and ensure we support them every step of the way. We provide a stable and reliable investment solution, professionally managed by our seasoned team. You can invest directly with us without going through a middleman, or you can invest potentially through a financial advisor. OzMIC is available in all the different account types. And most of all, as I said before, we aim to get rid of the unpredictable when it comes to your finance. We know every client is unique, okay? Let us take the guesswork out of that financial future. I'll personally be your financial concierge. So please do reach out to me if you have any questions, and I'd be happy to have that conversation with you. In front of you, you see my cell phone, and that will actually ring if you try calling me on it, and I will certainly pick it up. So please do, and I hope to hear from you soon. Additionally, you guys all have my email address, which you got the invitations from. So if you feel like reaching out via email is better, please do so.